Hi everyone, this is Demel Gonzalez from Heartwood Financial Services. Thanks again for joining us for another market update. As always, it's going to be a doozy. First of all, I want to wish everybody a belated Happy Mother's Day. I hope you all had a great time loving on your moms, and I hope you moms felt a lot of love. But thanks for tuning in to the presentation. It's going to be about 15 minutes long for the summary version. For those of you that want to get in a little bit more of the weeds, the rest of the program would be for you. But I hope you guys enjoy it. If you have any comments or suggestions on how to make the presentation a little bit more interesting for you, or maybe a little bit more convenient, please feel free to give me a call or send me an email. I'd love to get some feedback. Thanks again. Enjoy. Okay, as always, we like to get started with the asset class returns. Overall, we had a pretty good month for the month of April. You can see large cap stocks, the S&P 500 type stocks, were up over 5% for the month, and for the last 12 months, up almost 46%. Pretty strong. Small cap didn't do quite as well last month. Small cap had been doing really well for the last 6 to 7 months, so it trailed a little bit up 2.04, but still up almost 77% for the 1 year. It's incredible. Real estate was the standout, though. That was the winner for the month, up 8.28%, and starting to climb back. It had been trailing, and for the year, or for a 1 year, is at 30.58%. Still pretty strong, though. International markets did pretty well. Not quite as well as the S&P this year, but they had actually been doing a little better before, and now are starting to trail a little bit, mostly due to the fact that they haven't been dealing with the vaccine quite as well, and COVID is still more of an issue in a lot of the international countries. So developed markets up 3.35 for the month, still pretty strong though, and up 45 for the 1 year. Emerging markets up 2.93, up almost 48 for the 1 year. So still pretty strong results there, of course. And then we also have fixed income. Fixed income actually had a positive month. It's been trailing only up 0.1 for the last 12 months. So your fixed income has basically made nothing over the last 12 months. But starting to show a little bit of signs there, especially with the market having a little bit more volatility. It will be good to have a little bit of that, of course. High yield up 1.22%. So doing a little bit better than regular, high quality fixed income. Up 15% for the year, or for 1 year. And gold with a nice comeback, up 4.53% for the month. Actually, that's higher than the 12-month return for gold. So gold had been kind of trailing there for a little while, and starting to do a little better. Again, interest rates had been going up, but they stopped going up so much last month. Part of the reason why fixed income was up, but also another reason why gold was up, because interest rates weren't going up as much. Okay, now we have the market update for the month of April. It was an exciting month as usual. The big topic is about inflation, so that's why the title is Inflation Debate. Who's right? Is it going to be short term? Is it going to be long term? So we'll talk about that. But first, let's take a step back and just look at what's going on with the COVID numbers, because again, the economy is still very sensitive to what's happening with COVID. And I am happy to report that we are at close to the lows that we've been since the pandemic started. And so the case numbers, the hospitalization numbers, and the deaths, more importantly, are way, way down. So that's one of the reasons why we're seeing the economy just really just come back like gangbusters. It's been very exciting, very good to see. Now, we're doing a little bit better than some of the countries outside of the U.S., in Europe and emerging markets. So our recovery, I think, has been a little ahead of some of those recoveries. And so we'll talk more about that later. But that's important to know and to see as well. So inflation, is it going to be transitory? Is it going to be long-term? I'm going to get more into this in the extended version because I could probably do a whole video just on this. But for this version, the nutshell version of the answer is I believe it's still going to be more transitory. The position of the Fed is transitory or short-term. The difference that I have is I believe inflation is going to get a little bit worse than what the Fed is predicting, which is somewhere around 2.5 to 3%. I can easily make the argument that we're there right now. And it's only, May. So it could get much higher. I'm thinking it could even get into the 4% range. The biggest reason we're seeing this is what they call base effects, and it makes total sense because what you had about a year ago was deflation. People were all quarantined. And so now when you compare it to, March, April, May of last year, of course the inflation is going to look a lot higher. And I think that's part of the reason the market's getting a little spooked here in the last few weeks, especially some of these tech stocks. They get very nervous when there's potentially a lot of inflation. So again, I still see the inflation there. It's going to probably last about a year, maybe two, but then we're going to get a lot closer to normal after that. And we'll, again, get more into the nitty-gritty in the extended version. And finally, the April jobs numbers. Not much you could say about it other than it was disappointing. We were expecting this huge number of 1 million new jobs, and it was 266,000. Still great. So we can't complain about that. More people getting back to work. But that was very disappointing. There's a lot of arguments about are the incentives too good to not go back to work? Are people still concerned about COVID? There's still a lot of schools that haven't completely opened. So I'm not going to read too much into it quite yet, but it is definitely something as a caution to keep an eye on to make sure, hopefully we're not creating another problem with some of these stimulus plans. So definitely something to keep an eye on, and it's been talked about quite a bit. Okay, now we go into the market outlook. There's a very famous saying in Wall Street, sell in May and go away. It's kind of a seasonal thing where the market can sometimes be a little slower in the summer and pick back up again in the winter. I don't buy it. It hasn't seemed to work very well in the last 4 or 5 years. Maybe this year it will, and I actually do think there could be a little bit of a slowdown here. But again, you can't use those old cliches as hard and fast rules for the market. So first of all, I do want to start out with talking about where the valuations for the market are. We're at a, I have in the description here as frothy levels for the stock market. That's based on the estimates that analysts have right now for stocks in the S&P 500. And right now I'm seeing that the valuations are very high compared to the earnings. Now, my personal take on it is I believe that earnings are going to be better than the consensus. And so so that does make the valuations a little bit closer, but I could definitely see the market could have a little pullback. Maybe it's in May, maybe it's in June, who knows, maybe July, I don't know. But it can't just keep going up 5% every month. So we could easily see either a pause for a few months or a little setback in the next month or two. And I think that would be a very healthy thing. And Now that we're a little bit into May, we're starting to see a little bit of that potentially already happening. Now, the rotation accelerates is another key thing that is happening right now, and I think will continue for a little while longer. And what I mean by that is the value stocks, the more cyclical stocks, have been outperforming, and in the extended version I'll get more into that, but they've been outperforming for the last 6 to 9 months, and I see that continuing to happen as things reopen, as inflation heats up a little bit and people get back to work. So that trade, I think, is going to continue. It could get a little overblown because, the market likes to do that. It likes to take things a little too far. And there will definitely be some opportunities to buy some of those growth tech stocks that are not going away and are still making a lot of money. So we want to make sure that we don't completely forget about those. And then the opportunities, I think, are getting bigger and bigger in the international stock markets. I mentioned earlier the COVID numbers in Europe and in other places in Asia. I mean, they've been handling COVID, but it seems like it hasn't been ramping up, especially with the vaccine, quite as well as we have. And so I think they're a little bit behind in really seeing their economies ramp back up like ours has. And so I think that's a great opportunity. I just talked about how we're getting a little expensive. International stocks are still looking relatively cheap. And they also tend to have the types of companies that tend to do very well when the economies are recovering. They have a lot more of those cyclical stocks. And again, I'll show you more of that in the extended version. But finally, I'm seeing more of a market pause here either this month or sometime soon over the summer. And so I'm going to be, going in there and cashing in some chips, taking a little money off the table. You've probably seen a little bit of that already on the last few weeks. I'm not going to be super aggressive because I still think the market is going to do well. I'm going to be up from where it is to the end of the year. Of course, I don't know that for sure, but that's just kind of where I feel the market's going, especially with as strong as this recovery has been. And I'll be looking for those opportunities for the international stocks as well. If you have any questions, please feel free to give me a call. Let me know. We'll be happy to chat. The educational slide this month is grab an umbrella. So what we're talking about here are umbrella policies. So what is an umbrella policy? Basically, it's an insurance policy that will cover an additional amount of liability on top of your auto or home insurance. And umbrella policies are usually a minimum of $1 million and can go much higher. And so why do you need one? And I think a lot of people do underestimate their need for this. We live in a litigious society. That's probably putting it lightly, right? You don't need to go very far and see the billboards for all the personal injury attorneys out there. So you know what I'm talking about. And you get in a car accident or somebody slips and falls in your house and you have assets for an attorney to come after, they will definitely come after you. So what I'm trying to say here is it might be smart to have a little extra insurance to protect your assets in case something like that could happen. Hopefully it never does, but if it does, hopefully this would help. So what is the cost of these types of policies? They're actually fairly inexpensive. I was reading this article here that I referenced by Adam Grossman, and he talks about umbrella policies and how they can range anywhere from $200 to $400 a year for $1 million policy. And really, if you think about it, that's really not too bad. And as you go higher in the policy amounts, it is not a proportionate price. In other words, the higher you go, the cheaper it gets per million. So oftentimes it's good to maybe even go a little higher than you need just in case, because the cost isn't too bad. And so how much do you need? Well, a lot of that's going to depend on your assets and the types of liabilities you think you have. Like for me, I got a teenager and now he's on the road. So this is pretty important to me. So I've definitely have a liability or umbrella policy. And it's at a 1 million plus amount. And this is something that you may want to consider as well, just to protect your assets. The more you have, the more at risk you are essentially. And so this is something to look into. This is somebody you'd want to reach out to an insurance agent from your auto or home typically, since this is not something I personally provide to any of my clients. But I just thought this would be something good to remind everybody to look into. Okay? I always like to end with an inspirational note. I wanted to show you this verse from Proverbs since I've been hearing a lot of talk about cryptocurrencies and these different types of assets that are just going up astronomically fast, and a lot of times people feel like they're missing out. And so I want to bring this verse to you. It's Proverbs 13:11. Wealth gained hastily will dwindle, but whoever gathers little by little will increase it. So basically, I think what they're saying here is that these get-rich-quick type assets sometimes can be schemes, and oftentimes don't work out very well. Building wealth usually is something that takes time and goes, little by little. And so I think it does something to us mentally. We're appreciating it more. We protect it better. It just is a much better mindset. Just ask anyone who won the lotto. It usually doesn't always go very well. And so now you know where I'm coming from. Just throw some words of caution out there with some great pearls of wisdom here from Proverbs. Thanks, guys. All right, thanks for hanging in there. So if you're still watching, this is the extended version where I'm going to get into a little bit more of the detail of the outlook and the market update. And so on the market update, I talked about the COVID numbers and how they're really hitting some lows that we haven't seen in a while. And you can see it right on this chart here that the death numbers are way down, hospitalizations are down, and cases are down. So we're doing looks like a pretty good job of starting to get a little control over this virus. Now there's always a little anxiety over some of these new variants. So far it seems like the vaccines have been doing a pretty good job. We haven't seen any spikes. Obviously we've seen some of that internationally, especially in India. It's been really horrible to see what's going on over there. But thankfully, we've been in pretty good shape here. And I think a lot of that has to do with the fact that we've had lots of vaccinations. So the 1+ vaccine dose, we're over 152 million. That's basically about half of America. And most of those people, of course, are the elderly, the ones that had the biggest risk of really getting into trouble with this. So we're in much, much better shape. Part of the reason why we're starting to see such a great economic recovery. All right, so here's the moment you've all been waiting for. We get more into the inflation debate. And there's two sides to this debate. One is that there's going to be inflation, but it's only going to be short term. And on the other side is that this is going to be inflation like we haven't seen in a long time, and it could last a very long time as well. The one thing that they both agree on is that there is going to be inflation. And we saw the CPI numbers just early this morning, and it does look like it's starting to creep its ugly head, which is why the market's reacting a little negatively here this morning. So here's the case on both sides. First, on the transitory side, first of all, when a lot of people agree that there's going to be inflation, usually something else happens. I find that to be very true with the markets. It seems like there's a lot of consensus, and I would say that there's a lot of people that are leaning towards the long-term inflation situation. So I would almost make the argument that when a lot of people start moving to that side of the camp, that maybe that's not exactly what's going to happen. So that's one argument for the transitory. We also have the supply will catch up to demand scenario. And this does make a lot of sense. I mean, we shut a lot of things down last year, and we're just getting things ramped back up again. A lot of that includes manufacturing plants that make the stuff that we want to buy. And so when this happens, a lot of the input costs are going to go up. And so the idea here is that once things start to loosen up and more people get back to work, it's going to essentially alleviate a lot of the issues there. And so we'll see. That's definitely one to debate. Higher productivity due to tech. This is probably more of a long-term thing that with all the technology that we're using, it makes it hard for inflation to go up dramatically. Now, in the short run, it's not going to, I don't think, offset all the input prices that have gone up. But in the long term, it definitely will make a difference. And I believe that this is a very strong trend that will be around for a very long time. So again, makes a good case for this being more short term. Now, another point that I didn't realize until I read this article by David Rosenberg, I got referenced below. He talks about how the government spending has been so big, helping out consumers with PPP and stimulus checks, that the current spending right now on the personal side has been about 28% from the government. That's amazing to me. And so once that starts pulling away, then things will get a little bit more constrained and spending will obviously be down a little bit. But maybe it won't be too much because people will be back to work. But there's definitely going to be less of that government money out there, and so that will pull back a little bit of that demand for these different commodities and things that have been making inflation go up. And then the last point, which I thought was a pretty strong point, 8 million less workers today than in February that are out there. And so unless the government just continues to support these 8 million people forever or for a long time, things will probably start to slow down again on the demand front for a lot of these commodities. And so I think that's a very strong argument that this will probably be short term, because I don't see politically how we're going to be able to continue to support 8 million people unless they start getting back to work and supporting themselves. And so that's, again, I think another pretty strong argument for the transitory. On the long-term end of things, a lot of you, I think, are familiar with this. The stimulus checks have been going out. That's potentially causing inflation. A lot of the pent-up demand that happened from all the stimulus and the Fed. Break-even inflation rate at 14-year highs. I was just looking at that yesterday, and those are expectations for inflation to be as high as it's been in 14 years or so. Although I will argue inflation has been pretty low for the last couple decades. So that doesn't really say a lot. I mean, that's saying we're going to be maybe 2.5%, 3%. That's still not scary high, but it's definitely something to take a look at. Potentially higher corporate taxes. I think that's important too, because if corporate taxes go up, corporations really, in a way, don't really pay taxes. They just pass it along to the consumer. And so that could be in the form of inflation for everybody. So that could be an inflationary thing to look at. May not be as bad as a lot of people think. So that's why I'm in that camp of maybe that's a little bit more blown over than it should be. Commodities moving higher. Obviously, this is the impetus of a lot of the inflation numbers. And some people are arguing that it's because of the weaker dollar. That is, I would say, partially true. The dollar has been weakening, but it hasn't gone down that much. It's actually been kind of holding steady a little bit lately. And so part of it is the weaker dollar, but part of it is just purely the pickup in demand that we're seeing right now in so many different areas that's causing this inflation. So my nutshell version is we're going to see some inflation here, probably going to last for a year or two, might be a little worse than the Fed thinks, but probably not going to be 1970s all over again. All right, well, I am bringing back an oldie but a goodie here, talking about the market outlook. One of the first things I brought up was the valuation of where we are right now. And so I wanted to show you kind of the math for all the numbers geeks out there. These are the estimates for the S&P 500 currently, so 157.66, and I average out a couple different analysts' numbers just to kind of get a somewhat consensus number. And then the forward estimate, so basically the next 12 months, is 194 roughly, and that's a 23% earnings growth that's being estimated right now, which is awesome. I mean, that is some really, really strong growth. We haven't seen those numbers in probably about 10, 11 years. So it's really, really good. Now, based on where we are with the stock market right now, so we're at 4,100 or so right now, and it's the 12th, okay? And when we look at average, price to earnings ratios of 16 for forward, we're actually at about 21 right now. So when I say that we're a little expensive, you can kind of see the numbers. We're quite a bit expensive. And now I take into account that we still have reasonable inflation numbers. Now they are picking back up, but they're still reasonably low, and interest rates are still pretty low. And so with that being said, I add a multiplier to that PE ratio, which allows the stock market to be a little bit more expensive. And that still puts us at about 3,300 for the S&P versus 4,100. And when you add in the dividend for the S&P 500, that basically puts me at about 17% overvalued for the stock market. Now, some of you might be saying, holy cow, Demo, that could be a pretty big drop. Now, the argument that I would make here is that this 194 number is probably still too low. Consensus is, I think, too conservative. I think we're going to have some really incredible numbers this year. I would probably put us more in this range for earnings for the next 12 months. We'll see. But if I'm right, then that puts the earnings growth closer to 40%, which I think is doable just based on how bad things were last year and how strong things are this year. And if that's the case, then a realistic maybe 6 to 7% little bump in the road. I mean, heck, we can get that in a week. We've seen that with the stock market. And I think that would be a healthy little pullback if we saw that sometime this summer. And, and I might be wrong. This may not happen. And but, if it does, I would not be surprised. And that's kind of my thinking right now with these valuations. All right. In the outlook, I talked about how the rotation is accelerating. And again, the rotation is value stocks, small cap stocks, more of the cyclical type stocks that have really been doing well, while the more growth oriented type of stocks have been trailing a little bit, which is a change of direction from the last several years, which is why we're calling this a rotation. And so you can kind of see the numbers here. I'll have you focus on large cap growth. You can see that for the year, now this is as of the end of, the end of April, we had it at 7.8% for large cap growth. And if you look at what's going on in the value side, large cap value, it's up 15.7%. So that's about twice as good. Pretty impressive. But if you go to the 10-year annualized numbers, growth has been 17, value has been 11. So you can see that for the last 10 years or so, it's been all about growth. and now it's starting to go more into the value area. And I think this will probably persist for a little while longer. The economy is strong, it's growing, it's recovering, and this is probably going to continue until that changes. And it probably will change at some point. We can't run red hot forever. Things will probably start getting back to normal. And when they do, growth will probably start to win out again, because those are some secular trends that have been going on now for a while. But the opportunity and value still is there, and I continue to kind of move in that direction. But I am starting to see some opportunities in the growth side, especially for my longer term minded type clients, to take advantage of some prices there getting a little bit more reasonable. All right, now my last slide for this presentation is the opportunities in international stocks. I feel a little bit like I'm banging on a dead horse here, because I've been talking about this for a while, but we're really starting to, I think, see the potential for a big opportunity here for a couple reasons. First of all, you can see global earnings growth for emerging markets, and Japan and Europe are looking very, very strong compared to the U.S. So just purely from the potential for growth coming up here looks really, really strong for international versus the U.S. Now the U.S. is still very strong, so that's good to see, but international looks even a little better. Okay, but here's the cherry on top. If we go to the right, you can see where the valuations are. So currently the stock market in the U.S. is higher than average. So you can see the little diamond versus the little purple band where it's been on average. And when you go to like Europe or Japan, EM, China, you can see that the valuations are a lot closer to the historical band. In fact, in some cases like Japan, it's even below. Okay, and so the opportunity there for some growth is even stronger because of that. The last thing that I would point out here is we were talking about a moment ago in the rotation continues slide, is that these cyclical stocks have been really coming back and doing pretty strong, are performing very well. So these little blue diamonds here back on this left chart shows you the percentage of cyclical stocks that are in these, in these countries. And so Europe and Japan has a lot of these cyclical stocks. So now you're starting to see what I'm seeing. There's good earnings growth, valuations are strong, and they're in the right sectors at the right time. So you can see how this could be a potential opportunity, which is something I'm definitely going to be making some moves on in the next month or so. Thanks a lot, guys. Thanks for watching. Share with your friends. We'll see you again next month.